Hello everybody. Today I'm going to go over one method on how I actually value a stock, and I'm going to explain how it works, and why it's a tool, but not the only metric you look at specifically when we're trying to determine the value of pre-revenue companies like Hyliion. Don't be afraid of the numbers, we'll get there. Side note. I'm not a financial advisor. This is not advice. This is my own personal research and what I'm sharing with you today. This kind of stuff takes a lot of time, so if you like it, please drop a comment down below. So I built this intrinsic value calculator on Google Sheets on my own. I want to say that it was a lot of work, and it took a lot of time tweaking it and learning new ways of actually utilizing a spreadsheet. So if you're someone who doesn't want to spend hours building a spreadsheet and you want a clean and easy to use tool or tools that are reliable, heavily stress tested, then I would suggest you look at the Al Stock Trades platform. Like I said in my last video, I'm a member there, and it is the best decision that I have made with my financial future. Or for my financial future. Quite honestly, building this simple calculator I've put in front of you today made me realize how much effort Al has put into creating the tools that I use almost every day. His software is second to none, and I'll have a link down in the comments down below if you want to check it out. I have not been authorized to share any information proprietary to the Al Stock Trades platform, and I will not share anything like that today. So let's jump into this. What the hell is an intrinsic value calculation? Or in this case, a discounted cash flow evaluation? A discounted cash flow valuation is a financial model used to estimate the intrinsic value or the true or underlying worth of an investment, usually a company or some kind of an asset. The core idea is simple. Money today is worth more than the same amount of money in the future. This is due to two main reasons. Time value of money. You could invest the money today and earn a return, interest, and or profits. And or risk or uncertainty. A cash flow you expect to receive in 5 years is riskier than cash you have in your hand right now. So a discounted cash flow model answers the question, what is the future stream of money worth to me today? So I'm going to break it down a little bit more. How does a discounted cash flow valuation work? Forecasting. You start by estimating the free cash flow that the company will generate over a specific period, usually 5 to 10 years. Free cash flow is the actual cash profit left over after the company pays for its operations and investments. To calculate the terminal value, the company doesn't stop existing after your 5 to 10 year forecast. The terminal value is the estimated value of the company for all the years after your initial forecast period. It's often the largest single component of the discounted cash flow evaluation. And 3, discounting everything back to today. You use a discount rate, often called WACC, or weighted average cost of capital, to reflect the risk of the investment. A riskier company gets a higher discount rate. The discount rate is applied to each year's cash flow and the terminal value to bring them back to their value in today's dollars. This is the present value. The final DCF value is the sum of all these present values. The result of the discounted cash flow analysis is the company's intrinsic value. This is your estimate of what the company is truly worth. If the company's stock price or market value is lower than the intrinsic value you calculated, the stock is considered undervalued and might be a good buy. If the stock price is higher, it's considered overvalued and might be a risky buy, and you may want to wait for a better purchasing period. I want to add that the valuation model is absolutely not the only thing that you look at to determine value. This brings me to an important point here. I'm going to start with Clover Health because I know the company very well. We can infer from looking at the calculations that the current price is around $3.50. And the range for the stock price based on the relatively conservative valuation spans from $3.79 to about $10.77. That might make you go, wow, this must be undervalued. And I personally believe that Clover Health is greatly undervalued at this time, along with a lot of other beat-down healthcare stocks, the whole sector. But it's not just the numbers. They have SaaS contracts, and there's a lot of solid information that the group I'm a part of has put together to create a thesis that says Clover Health is going to be a massive winner in the next few years. This is where I kind of change gears and look at Hyliion a little bit. So, why the fuck does it say a few pennies? Well, we're going to loop back to the beginning. Free cash flow. They don't have it. Not yet. So, how do I value a company that doesn't have free cash flow positivity? You take a conservative approach and you assume the company is able to retain 5% of revenue, and that gave us about $175,000 in free cash flow. The real trick is that you will give us the real trick that will give us the boost that we need is they need to kick ass in 2026 and 2027. It's a small company moving into a growth stage. They may be able to 2 or 3x their revenue for the first 2 years. Who knows? I don't. But I believe I put it at 60% year-over-year growth. They could do a lot better than that. And if they make those first 2 years better than that 60%, then the rest of the years are going to compound at a higher rate. What I can tell you is that if they do absolutely hit the ground running, like they seem like they may want to this next year, this valuation is going to change dramatically. So let's face one more thing that might be bothering you. The stock price is over $2 for Hyliion. Should I just sell and get back in lower? Look, personally, I'm not a financial advisor, but I'm telling you that I'm personally not selling. If it dips hard, then I'll be happy to buy your shares at a lower price, and that's that. But I'm not selling. The foundation of a solid company is here. We just need the execution. Future earnings have already been priced in, but so what? People are out there buying Palantir at this current value, for God's sakes. Like, it could be worse. So, sell if you want to, but for me, there's a company here that is ready to learn how to run in 2026. I think that they have a really strong shot. We'll see what happens. Give me your thoughts down below. Did you like this video? Hit the like button if you liked it. And have a safe and productive week. Thank you very much.